And hello and welcome. Welcome to episode number 5353. That's right. We've already passed the 1 year mark. And so congratulations and happy anniversary to my two partners here. Last week we celebrated our 1 year anniversary here on the 5 year career, which means, by the way, that's 1 year down, four to go. So imagine for a second starting a real estate career or a real estate business that creates quality, consistent, exclusive leads and allows you to create a business that in 5 short years will pay you abundantly for the rest of your life. And I know it sounds, hard to imagine, too good to be true, but welcome to the 5 year career real estate podcast, a virtual seminar in every episode. The 5 year career can be found, by the way, at youtube.com/the @5 year career. Go check it out. There's 52 other episodes there and a lot of great information. But now, in the next 30 minutes, we're going to help you understand. Number one, hey guys, first of all, I didn't get a chance to introduce you guys yet. Let
Hey,
me start. Let me start by introducing my two co-pilots, Mr. Go Vertical, Mr. Patrick Butler, who will show you how to create a never-ending pipeline of, I always hear people say that all I need is more leads, but there's a way to create a never-ending pipeline of leads, and you're probably working, or you are meeting, or your spouse is working or meeting, one way or another. You're probably sitting on more leads than you know what to do with, number one. Then jumping over to my fearless friend, Mr. Skip Wiley, a veteran serial entrepreneur. And Skip also is known as the fanatical marketer, a serial entrepreneur, founder of $2 billion companies, Transcontinental Lending, for those of you who may have heard of that company, and ERA Realty. I'm sure you probably heard of that company. Now training real estate agents nationwide. So before anything else, I want to welcome and say hello to my two venerable partners.
venerable sir.
And hey, very, very important. Welcome back from your 5 year career journey to Portugal, which 5 year career helps you do that.
Absolutely. Yep. Got spent some quality time touring around in Portugal. And yet, and this is why this 5 year career concept is so great. You know, my business hardly skipped a beat being away. It's only adapting to the time zones. And I was analyzing how I might continue to do what I'm doing and maybe spend 4 or 6 months over there just to get to know a new country and a new culture. So yeah, great point, Skip. But here's another great point. Did you know that there were 322,000 foreclosures in the US in 2024? Last year, right? Everyone's thinking it's a great market. How could there be so many foreclosures in a great market? But there's foreclosures in every market. And the important thing for today's episode is we want to talk about how the mortgage nightmare doesn't have to end in foreclosure. It's the last and hopefully never option you have. We're going to talk today about 9 escape routes that many people don't even know exist. And not all solutions are permanent, but learn the most reliable solutions for your clients and help them to get started earlier, because time is your friend if you have a lot of time. And the earlier you get started in damage control or attacking a problem, the more options you have. So, where do I go to find experts to help my clients? Is your team prepared to help you with those kind of customers? I know right here you got a team to back you up that's doing that in real time. And after all, isn't that what we really want? And we're going to cover all this and more. So, with that being said, let's talk about the 9 alternatives to real estate foreclosure, offering our clients potential ways to avoid losing their property and how to get out of that situation with the least possible damage. Patrick, I'm going to throw it over to you. Let's start off.
Sure thing. And Eric, I think you said a couple of things that are worth reiterating in the opening statements. One of them is these 9 escape routes, some of them are temporary at best, others permanent. And as real estate professionals, we self-servingly can capitalize on a couple of these more so than others. But it's important to know what they are so that you can properly counsel your clients, your customers. The other thing is always be careful that we're not lawyers, so we don't practice law, we don't give legal advice. Direct your clients, especially if they're facing foreclosure imminently or considering bankruptcy, to talk to an attorney in that. But the first one we're going to talk about is loan modifications. And this is something that I am very familiar with, having been in that space many, many years ago after the Great Recession. And loan mods, once again, are oftentimes just temporary to get somebody back on their feet again. Basically, though, a loan modification is nothing more, nothing less than the consumer reaching out to their lender. Now, that right there can be a very complicated story because they may have gotten their loan with Wells Fargo because that's where they do their banking, and their loan could now be with Cornerstone Mortgage or PHH because those loans oftentimes get sold, as does the servicing, that is the collections and deposits and loss mitigation and all these things of the loan. So always make sure that if you're going to counsel your client, have them look at their latest mortgage statement. That should have the current lender servicer on there. What's going to be important there is the consumer must qualify for the loan modification. So what's very interesting about these things, they don't always make your payments go down. What? I can't afford my payment to begin with. How could it possibly go higher? Well, it may temporarily go down, and we're going to talk about a few reasons why that can happen. Again, if your client's issue is temporary loss of income or temporary setback financially, a loan modification could be a viable solution for them. How they do it, they can either adjust the interest rate lower, they can adjust the term of the loan longer, or they can reduce some of the principal balance, rarely on the mortgage that is currently in place. So loan mods, viable solution, sometimes only trial, by the way. If that consumer goes back into default, everything could be out the window and they may not be eligible for a loan modification again. So not something we can monetize on as real estate professionals. Lenders can, if you have an NMLS license, you can earn money helping somebody with a loan mod. So I'm going to go back to you, Eric, in the studio, because I know we've got other things to talk about.
Yeah, and just on that loan modification, that can be sometimes in the beginning, preemptively, even before you're late, or it can be one of the later when there's a whole conversation about the borrower's hardship and everything. We can go deeper in one of our next episodes. But Skip, let's talk a little bit about a word that most people don't even know the definition of: forbearance.
Forbearance, to delay, to stop a process. Eric, many people back in the early part of 2007, 2008, 2009 really had to deal with both loan modifications. And they started with forbearance, which is a temporary, totally temporary solution, perhaps, to saving someone from going into foreclosure. And it essentially reduces the payments for a specific period of time. And it's only temporary. But what it might do in the case of a person who has an auto accident, an illness in the family, a loss of a job, it might temporarily allow that person to pay lower payments. And by paying lower payments for that short term and a replacement of a full-time job, or insurance covering the debt that is growing in the case of an accident, puts that person in a position to again resume his normal and ordinary payment. By the way, it's probably the least used of the 9 examples that we're going to cover today, but it is a way for a lender to help a consumer who has paid his payments for a long time on time, but has a temporary problem. Back to you.
In the Florida marketplace, you see that often offered by lenders during hurricanes, right? When there are temporary things that occur, sometimes can put people out of work. They'll offer oftentimes 3 months of forbearance on your payment. They'll push those to the back end of the loan, but it will not affect your credit. So that's a good thing.
or supposedly won't affect your credit, and they're not
Supposedly.
supposed to
Right.
affect your credit. So this is where becoming familiar and becoming a great advisor to your clients really is that your opportunity to shine. You see, if you think about it, forbearance, remember during the pandemic when the government said and it was the first time ever that I've seen the government step in and say nobody has to make their payments during this, time of the pandemic. And so forbearance has been happening all along. In fact, you might even remember once in a while, maybe you had a credit card company say, "Hey, Patrick, as our thanks to you for being such a good customer, we're going to give you a payment holiday. And there's no payments required in the month of December. Normal interest rates will continue to accrue, but no payment is required." So just remember that even if when they reduce those payments, it doesn't mean that they're reducing their income, because they could add it to the balance. They can extend it and put it, quote unquote, put it on the back of the loan. There's lots of different ways, and it's important to read those contracts and those offers of forbearance, and of course know what good questions to ask. So another common escape of foreclosure is known as the short sale. And the short sale was really a great opportunity for many people. It's sort of like a reset, an ability to, wipe the slate clean, walk away, and everybody walks away friends. And what a short sale, what triggers a short sale, or what defines as a short sale, is when you owe more on your mortgage. In other words, the debt is greater than the value of the home. And at that point, lenders, which are sophisticated, understand that there's not going to be a graceful way out. There's going to be a loss taken somewhere. And so we might as well mitigate or minimize that loss by going ahead and not creating friction, letting the borrower off the hook as long as they cooperate and make things as easy and as quickly as possible. So a short sale is the lender approving you to sell the property at, quote unquote, market value, less than the outstanding balance. And then in a best case scenario, the lender then forgives that shortage. You've heard of people that when they had cars repossessed, and then the lender comes back after them for what's called a deficiency. And that happens in mortgages as well. But in an ideal short sale situation, and again, sometimes you have to ask, they're not automatically giving you these things, but a lender then forgives the difference. Although also, as Patrick mentioned, there may be tax implications. Consult your tax advisor if you are considering a short sale. Skip, let's talk about something known as a deed in lieu of foreclosure. Sounds like a fancy French term.
Well, it's not a happy time, so let's discuss what a deed in lieu of foreclosure is. You've tried forbearance, you've tried a short sale, you have no equity because you bought at the wrong time and you owe more than anyone will pay for it. And you have really two options: go into foreclosure, or maybe help your credit report sooner by deeding that property back to the basically the person who gave you the loan. And unfortunately, for many people in today's world who bought in 2021 and 2022, you may have paid too much for those properties based on low interest rates and stiff competition. So is it a better option than a foreclosure? Yes. And the reason why it's a better option, that foreclosure stays on your credit report for 10 years. In deed of lieu of foreclosure will be perhaps, and I'm not giving you legal advice here, but I'm just offering that your credit report will be improved much more quickly with a deed in lieu rather than a foreclosure. It's essentially giving your property back to the lender. You have no other options, and it is a solution that will help you both in the short run, immediately, in the long run, with credit.
You know, I wanted to add to that because that's a really good point. The deed in lieu of foreclosure sometimes is offered early in the process. A lender figures, it's very easy. Why don't we just all cut our losses? And one of the reasons why it affects your credit less is because when other lenders later on look at did you work out? Did you responsibly handle what regardless of what caused the problem, did you work with the lenders or against the lenders? And in a deed in lieu of foreclosure, very often they'll say, listen, just mail us the keys. We'll let bygones be bygones and we'll forgive that deficiency. Once again, a deed in the worst thing that happens, and that's why we say that the foreclosure is the last, if any, option at all, because once the foreclosure goes all the way to the end, we'll talk more later, then the lender has no incentive to forgive the deficiency. And then, as Skip mentioned, credit, foreclosure is the atomic bomb of your credit.
Eric, I have another comment about that too that I think is really important, and it relates to the feeling that you have about being foreclosed versus deeding that property back. That's an emotional thing, but it impacts our whole life. Our emotions impact every decision that we make in the future, and I think it also takes a great deal of pressure away from the person who maybe has no other option, and it's something, and you made mention of this early. You better read your paperwork clearly, and you want to make sure that when you deed it back, there's no other obligations that you have before you deed that property back to the lender.
Very true.
Absolutely. So
I've got a question.
Yeah,
I'm
go
sorry.
ahead.
But so if you decide to not go through with the loan modification or a short sale and choose deed in lieu early, as you mentioned, Eric, is that known as skip to the lieu?
Yeah, it's good to have a little bit of humor. I know it's a tough
little humor.
and a heavy subject. One more point before we go on to the next escape route is, do you notice that all of these solutions that we've given you so far involve contacting the lender?
Right.
Probably one of the most important things in this whole process is communication. We think that, avoiding the phone calls of, don't open the mail and everything is gonna delay or prolong it. It may delay it, but it won't solve it. Oftentimes, these 9 different escape routes start with communication, and that's very important to realize. Let's talk about another one. And again, I'm going to throw this one over to Patrick because he's spent a good deal of time in the world of bankruptcy. He's not been in bankruptcy,
Thank
but he's
God.
been helping a lot of people in bankruptcy.
It's funny, man. As we talk through these subjects, I've spent a lot of time in all of these things. It's funny because we call me Mr. Go Vertical in affinity marketing and stuff. But now that I think about it, the majority of the time I've spent and the money I've made in this business has specifically been in default real estate, namely short sales and short sales in bankruptcy. In fact, even today, as part of my 5-year career, I've got to deal with a big investor group working on short sales, interestingly enough. But Eric, you said something super important. And as real estate professionals, we've got to understand from the poor consumer's perspective, the few times they have heard from their bank, if they are behind on their payments or in default, has been from the collections department. And collections calls are never any fun, no matter what it is. Car loan, credit cards, collection just make you feel bad, make you not want to answer the phone. And the consumer really needs to be coached to understand that your call to the bank is not going to go to collections where they're going to ask you to make a payment, although they may. It's going to go to the loss mitigation department, meaning minimize losses for the bank. And they want to try and help people. They really do. It's after the Great Recession of 2007 and 8, the Consumer Finance Protection Bureau came out with a bunch of guidelines, namely to say to the banks, thou shalt not foreclose unless you have to. And the banks do follow their protocol. And as we just saw in our opening remarks, over 330,000 people still went into foreclosure. So yes, do reach out to your lender. Another temporary solution is filing bankruptcy. And again, ideally, Although you can do it yourself as a consumer, called pro se without an attorney, you should really get a bankruptcy attorney to help you. But in nearly 15 years of running bankruptcy real estate short sales, managing it for trustees, I learned some very important things. There are two types of bankruptcies, and I won't get into the whole diatribe here, but there's the Chapter 7, which is a liquidation bankruptcy, where you're supposed to liquidate your assets through the federal trustee to pay off other debts, such as credit cards and medical bills. Then there's a Chapter 13 bankruptcy, which is a reorganization bankruptcy, where you don't sell off your assets, you reorganize your debt. Now, here are some cold hard statistics. 95% of the Chapter 7 bankruptcies never result in the sale of a property, even though a significant percentage of those homeowners, if they're homeowners, still lose their home to foreclosure after the bankruptcy. And that's a super important point for real estate professionals. And we've got an entire program on this called the Bankruptcy Specialist. But those are golden opportunities for us to be listing agents to help those consumers if we knew what the heck we were doing and knew how to find these basically needles in the haystack. And they're very, very identifiable. So over 90% of the time. By the way, if you want to do bankruptcy sales, do you need to become best friends with the trustee? No, because 95% of the time they never sell the property. You don't even need the trustee. Forget about them. There's ways to go after that. Number two, the Chapter 13, that's a reorg. 85+% of the time, the Chapter 13 never sees the end of the 5-year plan, and the same story happens there. And the reason for all of this is because the homeowner typically cannot afford their home. Something happened along the way that forced them into bankruptcy, job loss, death of a spouse, career change, whatever the case may be. And unless their habits or their income changes dramatically, they're going to be right back where they started. So very temporary solution. Bankruptcy often used as an immediate stop for foreclosure. And I'll end this piece here. In a short sale, a loan modification, or anything else, we've got to advise our clients, you've got to do all these things outside of 37 days from the foreclosure sale date. If you get inside that 37 days, the lender has no obligation to do anything. Outside, they do, per the CFPB guideline. So again, another good way to go down the path. We can go on for hours about bankruptcy. So Eric, back to you in the studio, sir.
So we've already given you a number of different, and I will also want to stress that they're not necessarily in the order that you might approach it. Okay. So for example, another escape route is refinancing. You see, if you see an imminent problem coming, but you're still on time, everything is still good, and there's equity. You see, that's why you got to know what are the factors that affect or kind of lead you what the best escape route is. But if you're still not behind or very little behind in some cases, and you have equity in the property, you're not upside down, okay, then maybe take a look at refinancing. In fact, it may be my favorite solution up front, if that's a possibility. If I can refinance, extend the term, maybe lower the payments, get a better interest rate, consolidate some debt, there's a lot of different factors that we want to look at. So if you have equity in your home and your financial situation hasn't deteriorated yet, although you see it on the horizon, this involves taking out a new loan, pay off your existing mortgage, possibly securing lower interest rates. And remember, it's not just about the rate on your mortgage. When you look at the blended rate of all of your debt, you may find that even though you have a low interest rate first mortgage, but when you add the 46% interest rates on your credit cards, the double-digit interest rates on automobiles and other types of loans, that when you combine them, even at a higher rate than what your mortgage was, you still come out with a lower effective interest rate, and more importantly, a lower payment altogether of all the payments put together. So refinancing is one of the ones I like to explore first, and that usually starts with, are you behind, or how far behind are you? So Skip, I can't refinance. The market is too strong, so the lender is not inclined to do a modification, but I'm not upside down yet. Okay, what's another escape route?
Let me see if I can figure this out. You got equity and you have time, and you could call a real estate agent and ask them to help sell your property before you go into foreclosure. No, I made a little humor there, but the truth of the matter is anybody who bought before 2021 has equity, more than likely, because property values went up 20% 2 years in a row in many markets across this country. So if you own a property in prior to 2020, what was it, 21 and 22, you most assuredly have some equity. And why do people wait and wait and wait and wait? Emotion. Again, that's their home. It impacts their family, the schools their children are in. But it happens to the best people. So the best thing to do is, when you know you're in trouble, is address the issue early, put the property on the market, walk away with equity, less stress, and by the way, a happy wife probably, and a new life that you start over again.
And maybe some money, right, for a fresh start. And maybe, maybe there's a little bit of resizing, downsizing, right sizing, whatever you want to call it. But there's something to be said about what you just said is, happy wife, happy life. The stress when a house is in distress affects everybody in the house.
I wanted to bring that up. Divorce is heavily tied to financial crisis.
Yes.
And if you're in a foreclosure situation, you get rid of the problem. Don't get rid of the wife.
You know what the #1 cause of divorce in America is?
No.
Marriage.
Yes, it's marriage. #2 is finance.
You guys are rough today, but I like it.
Hey, it's Friday. It's all good. It's all good. But so some creative, out of the box thinking at the time, like you said, if you see that there's going to be a problem, selling the property early on in the game is the easiest because you have the most time. You're not in a distress. As time goes by, you may have to be more negotiable, etc. But here's another option, Patrick. What about renting the property? Maybe you can hold on. Maybe the rent could pay the payment even though you can't.
So, this is an opportunity to potentially turn lemons into lemonade, as they say. Gee, I'm in a situation where I can no longer afford to live in my own home. And what am I going to do about that? And I'll give you an example how that can happen. I live in a gated community, and our maintenance fees have gone up pretty significantly over the last few years, and for a lot of reasons. But nevertheless, for some people, that may be just enough to put them over the edge. In fact, I know a couple of families in my neighborhood that have been kind of murmuring about that because they're already very close to being unaffordable. I even would submit that some of these solutions could be combined or layered. Perhaps refinancing your home to wipe out large credit card debt, if you have some equity, may be a great solution. And then looking at the potential of renting that property out to somebody to cover that payment. Now you happen to be doing one of the things that we preach to the choir about here, which is owning investment real estate. You just went from potentially being in financial distress and losing your home to now being an investor owner. And yeah, lick your wounds, go get your rest of your life back in order. Your home is still in your name, being paid for by somebody that is in a better position to do so. And now you can potentially come back to that house or go buy another house as a first-time home buyer 3 years later, or as a regular buyer if your situation improves. But again, talk to your real estate and your mortgage professionals about these potential solutions. So yeah, renting is definitely an opportunity, and it's one of the great wealth builders of our nation. Something that you definitely want to talk with professionals about. And our automatic landlord, Eric Wilner, would be a great person to chat with about. He also happens to be a mortgage professional. Skip and I have both been around these parts for a long, long time. Something we could definitely talk about. Now, bear in mind, that renting property also means you have become a landlord. And as Eric Wilner can point out, there are some responsibilities that come with that. So you'll want to coach your clients as well as to whether they should be considering having professional property management handle that stuff, or if they want to do it on their own, or maybe even hire you, the real estate professional, if that's part of your bag of tricks. So definitely an option. And that can both be short-term or permanent, depending on how we look at it.
Well, that's a great point that you make right there at the end, because sometimes if you think that the problem is permanent or long term, some of the options are better. Selling the house and getting a fresh start, the short sale and so forth. But if you think that the problem might be temporary because of the economy, maybe something going on in your industry, or when I say your industry, your client, your customer's industry, and if the problem is temporary, then the idea of renting it out, relocating, doing whatever you got to do, right? As the saying says, it takes what it takes, right? And now, if you have that solution, at least temporarily, then you can look around at other options. And speaking about other options and experts and professionals, working with a housing counselor is another escape route. There are both HUD approved housing counselors. You've heard of NACA and a whole bunch of other ones that can provide free or low cost guidance on foreclosure prevention options. Notice what we said, foreclosure prevention options. If there's one solid theme, one solid thread that goes through everything that we talked about, is to prevent the ultimate, what I call the atomic bomb of credit, is foreclosure. And they can help you understand your rights, understand and explore different alternatives, be realistic with them, and negotiate with your lender. In some cases, they'll even get on the phone and make some of the calls for you. They can be valuable resources, but so can you. Okay. So can you. And in fact, I'll even say, who do you think is a better resource? A government employee or an expert in their field of real estate? So hopefully this rounds out. And if you want a copy of all of our 9 escape routes, I'm going to tell you in a little bit how you can get that. But we also have a do it for you component to our programs as well. You don't need to be an expert in every one of these areas when you build the right team around you. And one of the most effective ways to find people that are in these situations are through the use of webinars. And we have a turnkey, automated, done for you, massive lead generation system that we call it our done for you program. And you don't need to do the webinars yourself. You can leverage our turnkey proven webinars already. So, Patrick, thank you for your expertise and your knowledge. Skip, thank you for all of your expertise and knowledge. I think this was a great episode here with a lot of great information. If you want to get a copy of our transcript for today's program, text the word solutions to 561-861-2366. That's the word solutions to 561-861-2366. Again, guys, thank you for joining us on the 5-Year Career Podcast. Continue on with our journey here. We hope you enjoyed today's episode. And if you liked what you heard, don't forget to subscribe down here, up there, wherever it is on your screen. Rate and leave us a review or a question. Your feedback means the world to us. Stay tuned for more exciting content. This week is 53. Next week will be 54. Use this information and build your 5-year career. And remember, you can find us at youtube.com/5-year career. Like us, follow us. Also, Patrick's going to put on the QR code here for you that if you want to check out one of our turnkey webinars, come test drive, be a fly on the wall, and take a picture of this and register for our next upcoming webinar. The dates will be on there when you log on there. Any final parting comments, gentlemen?
Yes. 8th of April, first-time home buyers. 14 days later, our first webinar on how to help people who already own a home buy their first investment real estate. 2 webinars every single month for the balance of this year. Join us.
Awesome.
Patrick?
Nope, that's it. I'm looking forward to our next episode. Until then, sayonara, everybody.
And remember, 5 years to financial freedom. It all starts with lots and lots of leads. Take care and happy listening. Bye-bye.